All right. So thank you for everybody that's able to be here. Basically, it's going to try to keep it pretty short and sweet. Just a intro to home ownership class. I'm going to go ahead and share my screen here. As we get through it, thank you, DJ. The screen two. And then boom. All right. So this is our intro to home ownership course here. My name is Dylan Estes. I am the branch manager here with Gateway at Nexa Mortgage. The intention of this class obviously is to give you just a baseline of things to know, things to prepare for as you go into buying, whether it's your first home, your next home. And then at the end, we'll touch on some different investment property or different investment type of loans, as well as other products. That being said, if you've ever used Zoom before, there is a chat feature. There's also a hand raise feature. We have, this is myself right here. I'm your presenter. Again, Dylan J. Estes. I'm the branch manager. I am a mortgage broker as well. However, these days I do a little less in production, a little bit more on the management side of things. On the next slide, I'll introduce our co-host, if you will, our folks that will be answering questions in the chat, our loan officers, as well as my right-hand man, Damon. But I'm in my fifth year of mortgages. I've funded over 400 loans, and that's over $60 million in loans funded. I'm licensed in 17 states. All those states right there are states that I am in, working on a couple other ones, including my man, Mike, Tennessee. And then, but my number one job, my number one goal really is to be a resource. So I mean it when I say, whether or not this is if you're coming just for information, if you've already been pre-approved somewhere else, if you're sister, brother, mother, father, whoever is in the industry, and you know you're going to go through them, that is perfectly fine. No big deal at all. Just want to help. These are the kind of things that they don't teach in school that they probably should. So Gateway is dedicated to helping educate borrowers and make sure that people know these types of things. So that being said, these are my co-hosts. I've got the lovely Miss Heather Edwards. She has been with me for over 2 years now. And then I've got Stacy Blankenship. She just joined our team a little bit earlier this year. Both of them are excellent loan officers and very knowledgeable. And then again, my right-hand man, DJ there. All three of them will be in the chat. If you guys have any questions or need anything, feel free to put it in the chat. If you want to, raise your hand. But at the end, we will have a open forum question and answer. But those are our fine staff here. And then jump right into it. So these are some pretty basic terms that I would recommend that you know going into it. And then I got a little bit more on the next page, but your appraisal, and these are in no particular order either, except for and not even alphabetical. So appraisal, that's going to be what once we get going in the process. So basically the way it'll go, you get pre-approved, you go out, you go home shopping, you get into a contract, you'll have an inspection. Once you get your inspection taken care of, then we order the appraisal. Okay, so your appraisal is going to be what tells the lender and you and the seller the true value of the home. Okay, so it's based off of market conditions. It's based off of comparable sales, typically within the last 6 months, within about a 3 to 4 mile radius of the subject property. But the key thing there is that it's a key piece of the equation, because ultimately that tells the lender how much they can lend, and it'll tell you what your home's value is and all that good stuff. Closing cost, that's an important one. Appraisal actually goes into your closing cost. It's considered a closing cost. Closing costs are going to be, so this is one of my most important things to hit on in this class is a lot of time, especially for first time home buyers, you know, everybody has this 3%, hopefully 3%, 3.5% number that they're trying to save up for to buy a home. And then I can't tell you how many times I speak to a borrower and we get rolling and we get to the portion of the application. I say, okay, what are our plans for closing costs? And they look like a deer in headlights. What are closing costs? So closing costs are going to be, they're broken down into a couple different sections. The first one's going to be origination charges. All right, that's going to be things like underwriting, processing, anything that the lender itself, or points, right? Or if you want to buy down your interest rate, anything that the lender itself adds to the closing cost. That's going to be your origination. One key note there that I really want to stress and tell you what makes us special here at Gateway is our 9 times out of 10, unless we're doing a specialty loan, meaning like an investment, DSR, bank statement, something like that, where we have to go to a non-QM lender. I know that probably doesn't make a whole lot of sense. Let me simplify and say, if we're doing a traditional mortgage, conventional FHA or VA mortgage, 99% of the time, our origination charges are a big old fat zero. Nexa is the #1 purchase lender in the country. We are 1,500 LO strong. We have a fantastic presence in the market, and with over 160 different lenders, most of my lenders do give us premier or favored pricing. And one of the things I have negotiated with them is my clients do not inherit any underwriting charges from them. And then in addition to that, we are self-sufficient. I have taught my my loan officers how to self-process loans. So that right there is going to save you anywhere, just on the processing alone, it's going to save on average about $800 is what industry norm is. Between the processing and the underwriting, we eliminate about $2,000 off of closing costs. So what does that leave? Well, that's going to leave, the next section would be services, or services that you cannot shop for. That's going to be your credit report, your flood certification, what's called a MERS fee, which literally means mortgage electronic registration system. It's a government monitoring system on mortgages, as well as any other virtual fees or closing fees that may be attached. Typically that section comes out to be a couple $100 plus your appraisal. Now your appraisal, which we talked about earlier, is paid for, generally speaking, prior to closing. Here in St. Louis, our average appraisal depends on the loan type. There's a couple things that go into it, but for the most part, they range anywhere from about $500 to $600. Once you're in contract, we've got past the inspection, we order the appraisal. You would be charged that $500, $600, whatever the case is, but it is reduced from the cash to close. Okay. And then outside of that, you would have title work. And then another key word is escrows. That's gonna be your taxes and insurance. So whatever home insurance policy that you elect, if you escrow, which means you pay your taxes and your insurance inside of your mortgage payment, then you're going to pay a year's worth of that homeowner's insurance up front. Everything is paid pretty much in advance, right? So that premium very much depends on where you're at, how much insurance you want, how many bells and whistles on that policy you want, all that good stuff. But generally speaking, what we see for the most part, I would say here in our area, our average loan amount has gone up pretty substantially over the last few years in the market that we have. But I would say our average loan amount is probably sitting somewhere in the ballpark of about 275.
I'm doing well.
DJ, please mute. Probably about 275. So then from there, there we go. I got the ability to mute, baby. That's the beauty of being the host. All right, so I would say on average, our closing cost on what we typically see is somewhere in the ballpark of about roughly between $3,000 and $4,000 is typically where it falls in, and that includes that homeowner's insurance policy. That being said, obviously, if you're buying a $500,000 home and your homeowner's insurance policy in itself, or if you're in a flood zone or something like that, you know, your insurance policy in and of itself, like when I do loans in Florida, if they have to have flood insurance, it's not uncommon for their just insurance portion to be $3,000, right? And then you got everything else on top of that. So there's factors there that kind of come into play, but general rule of thumb, we're going to be looking at somewhere in the ballpark of about $3,000 to $4,000 on closing costs. All right, so the next thing is your credit score. Credit score, man, this is something that I really wish was emphasized more in our especially public school systems. A lot of people, especially young borrowers, when I speak to them, they don't know anything about credit. They don't know how to establish credit. We're going to talk a little bit about that later on, but ultimately what your credit score is it is a way for it's literally your credit worthiness. It's how likely are you to repay this loan? How risky are you to lend money to? That's the easiest way for me to explain your credit score, and we'll dive into that a little bit deeper here in a little bit. Pardon me. Pre-approval letter. So your pre-approval letter, once you speak to either a mortgage broker or a mortgage banker, they get your application, they get your documents, they get everything in. There's a key difference between pre-qualified and pre-approval. Okay, both are different types of letters. Pre-qualified that's just simply the loan officer stating, yep, I've seen everything I need to see. This loan is a good deal. It will fund. That's pre-qualified. Pre-approval letter is that loan officer took the application, the documents that you submitted, and they actually submitted it up through underwriting, and the underwriter signed off on it and stated that this is a good loan, that it will fund. Generally speaking, a pre-approval letter is stronger, obviously, than a pre-qualified letter. I will say it depends on a few different factors. And honestly, one of my favorite lenders, UWM, they will do a fully underwritten loan just through, I can go through and get it pretty much automatically underwritten to get that pre-approval letter same day. Some lenders, if you submit it up, it can take anywhere from 3 days to 2.5 weeks to get the pre-approval letter back. And in this market, any realtor will tell you 2 days, let alone 2 weeks, is a eternity in the market. You might see a house that you absolutely love, and if we're waiting on that approval letter from one of the, I would call them, I call UWM, Home Point, those kind of lenders, blue chip lenders. But if we're working with a 580, 600 credit score, and we don't qualify for one of those higher end lenders, and we're going through an equity prime mortgage or somebody like that, great lender, don't get me wrong, but they don't have the speed. They don't move as quickly. So those are things that can slow us down. That's why it's important who you work with. My pre-approval letter or my pre-qualification letter, if I go through and I do my analysis, I don't miss. If I give a pre-approval letter or pre-qualified letter, we're going to make it through underwriting, quite simply. Then from there, we have the piece of the closing costs, or the expense, I should say, that most buyers are aware of, and that's your down payment. That is the portion of the purchase price that you're putting down on the home towards the principal, right? And when I say principal, I mean that's your home's value. So for example, we're going to use nice, easy, solid numbers. $200,000 home. You're doing a first-time home buyer, you have a nice, pretty 720 credit score. We're doing a conventional first-time home buyer, 3% down. Your down payment in this scenario would be $6,000. So that $6,000 would go towards the $200,000, and your remaining loan balance or your loan amount would be 194 grand. Okay. Then you have your mortgage rate. That's going to be the rate of interest that the loan has, right? And it's been a hot topic here lately. It's you can't turn on the news without hearing rates are going up, rates are going up, rates are going up. And that is one thing I want to touch on in a little bit more depth here. And that is that right now, we got spoiled over the last 2 years in the mortgage industry with extremely low interest rates due to COVID and due to economic hardship. And that was the way that the feds tried to stimulate and keep the economy going. Not just mortgage rates, but interest rates across the board. Well, now we're in kind of this weird area where inflation is through the roof. It's at 8.5%. We have the unfortunate war with Russia and Ukraine going on, a lot of uncertainty. And ultimately, what the Fed does to combat inflation, that's really the biggest piece, is they start to increase interest rates. So, this time last year, the average, and I'm shooting from the hip here, this isn't exact, but the average interest rate was probably somewhere in the ballpark of about 3.25%, give or take a quarter of a percent. Right now, my average interest rate is sitting a little bit north of 5%, probably about 5.5%, somewhere right in there. So a couple key things here. One being the difference, and I probably should have made a slide for this. And I'm going to make myself a note to update this. D, if you can as well. But the one key difference between a mortgage broker and a mortgage banker is your interest rate. Okay. And so to give you the elevator spiel, instead of bogging this down with why brokers are better, which is absolutely true. There's a reason 5 years into my career, I made the switch over to being a broker, because I understand and understood that I could be way more cost effective and take care of my clients better by being a mortgage broker. The way that I'm able to do that is quite simply through margin. What you have to understand when you walk into your Regions, your Wells Fargos, your US banks, the big boys, right? You're paying for that name. You're paying for, they have what's called uncapped margins. And what that means is that they can quite literally charge whatever they're able to get away with. So when they close a loan, they have quite literally anywhere on the low end, about 5 on plus corporate, on the high end, upwards of 7, 8, 9, 10 people to pay through that loan closing. That's a lot of margin. On average, a retail lender is going to be somewhere in the ballpark of between 5 and 6% on their margins, meaning that's their revenue that they make off of a loan. As a mortgage broker, my brokerage is capped at by the federal government at 2.75%. What that means and what that equates in layman's terms is a broker we can only charge up to that amount. And so that leaves lower compression for lower interest rate, lower costs. That's why, as I alluded to earlier, there's no underwriting, there's no processing. I'm able to cut a lot of that out, and I can't make money on third-party services. A retail lender can. So all that condensed down to say, rate is absolutely important. There's so many things to break down and look at. But at the end of the day, the most bang for your buck, whether it's us here at Gateway or somebody else that you trust, a mortgage broker is going to give you, the client, a better overall deal. And then from there, you have your inspection contingency. Now, this is something that I have a lot of really, it's funny. Most of my realtor partners, I don't even really consider them, partners, moreover friends, because we have conversations, we go into deep conversations on how we can best position ourselves and how we can, really separate ourselves in the market. And one thing that was talked about in the market conditions and being as competitive as they were, you go look at a house and there might be 10, 15, 20 different bids on that home that you're trying to bid out and win. Sometimes a realtor would say, well, I advise my clients to waive inspection. And this is something that honestly, it makes me cringe a little bit. I can't in good faith recommend to a client to waive their inspection. That being stated, the inspection contingency is just simply stating that that the inspection more or less isn't going to be something that will waiver you from being able to get out of the loan. So what I tell my clients is, if you decide that you are in a high bid scenario and you're open to waiving your inspection, still get your inspection, right? Still spend that money, because it's really insurance at that point. And depending on, and on that note, one thing you want to keep in mind, and all this, I mean, it's really tough to try to condense home buying into a 45-minute to an hour class. So if these things spark different questions, please feel free to reach out and we can talk about them in more depth, or shoot something in the chat and one of the ladies will clarify. But ultimately what I suggest to my clients is hey, if you're going to, and we work as a team with the realtor, whether it's the first time I've worked with a realtor or the 10th time I've worked with a realtor, is if you're going to waive your inspection, then put less down on your earnest money, which is another term I'll hit here in a second. And that way you still get the inspection. If something detrimental came back that you're not comfortable with, you can still walk away from it. Yeah, you're out of your earnest money. Yeah, you're out of the money that you put on the inspection, but ultimately you are able to present a higher bid offer. And if you do the walkthrough, you went and looked at the house and nothing sticks out to you, you have to get an inspection, because that's going to tell you what the bones of the house are, right? That's why that's so important. But in this crazy market, it is very common for buyers to fall in love with a home, waive that inspection, and then that just leads to, I've got buyers, man, it breaks my heart. They'll call me because I tell them straight up, you need to get the inspection. I had a lady last year reach out to me and say, hey, I got this house and moved in and it starts raining, and all of a sudden I've got 3 inches of rain in my basement. She didn't get an inspection, so she didn't know she had a crack in the foundation that was underground. So those are the kind of, and not that necessarily would have came up anyway, but those are the kind of things that's why it's so important to have that, and for that peace of mind, because at the end of the day, it's a 6-figure investment, and it's something that you need to be cognizant about, and you need to know what you're buying, quite frankly. And then boom, the last one on this slide is the biggest, in my opinion, one of the biggest pieces of home ownership, one of the biggest reasons to own a home, and that is your dormant asset known as equity. Equity is the percentage of your home, or the dollar amount of the home, that is the difference between what you owe and what it's worth. So in that example that we spoke about earlier, 200,000, you put 3% down, your loan amount's 194. Well, your home is one of the very few things, one of the very few assets that you will buy or purchase that appreciates, not depreciates, over time. What do I mean by that? Well, you go to the car lot, you buy that nice fancy Ford Mustang. I don't even know what a Mustang costs. It's way too much car for me, but let's just say for conversation's sake, $25,000. All right. So 25,000, you drive it off the lot. That baby just lost 20% right off the rip, meaning now your nice fancy for a Mustang is worth about 20 grand, right? You just lost 5 grand the second you drove it off the lot. With your home, on the other hand, typically speaking, now we are in a weird market where appreciation numbers in our area here in St. Louis are between 15, really between about 13 and 18%, depending on the area. St. Louis is a strange metropolitan, but call it an average of about 15%. That's about 3 times as high as what the average was prior to COVID. So I'm conservative when it comes to other people's money. So I'm gonna use some pretty conservative numbers here. I'm gonna go pre-COVID because I do think you hear people talk about the bubble and this housing market crashing. I'm gonna be perfectly honest with you. I don't think that there's any kind of bust looming. I don't think there's a bubble that's gonna pop. And I've got a plethora of information that I could expand on that. But that's a whole nother subject. So for conversation's sake, I'm going to hit these same, we're going to go back to pre-COVID numbers. Let's say that, and let's get it even a little bit more conservative. Let's say 3% year over year is what your home appreciates. So that $200,000 home that you just bought, after 1 year, it's worth 206. So it gains about $6,000 in appreciation year over year. That means that after 3 years, your home that you bought for 200,000 is now worth 218. After 5 years, it's worth 230. You know, and it keeps increasing. So ultimately, you know, what this opens up for is you're building your portfolio, you're building wealth, you're building something to fall back on. Prior to the craziness that was the last 24 months with refi boom and all that good stuff, one of my favorite types of loans to do was a refinance where you'd have somebody that'd been in their home for 5, 10, 15 years, whatever the case was. Maybe they got, you know, we live in America, right? We're a debt heavy society. Everybody carries quite a bit of debt, unfortunately. But you get somebody that has, you know, that equity that they built up over time, and then they've built up $20,000, $30,000 in credit card debt. One of the things you can use your equity for is to be able to take care of that other debt, pay it off through your home's value, that equity that you built, and overall lower your monthly expenses. That's the kind of vehicle and the kind of power that equity holds outside of when you sell, you make a profit, right? That's the one that everybody thinks of is selling and making a profit. So equity is a big thing. It's a key thing. And it's probably, in my opinion, the biggest piece to home ownership. Outside of that, we hit quite a few of these. Earnest money, that's the money that you put down. It's basically good faith money that you put down to that seller, that you are serious about buying the house. That being said, you know, if you put that good faith money down, you don't have an appraisal contingency, and which means the home doesn't appraise, and you're not comfortable with, you don't want to overpay, seller's not coming down, you can get out of that contract, you can get your earnest money back. There is ways to get your earnest money back if the deal goes sideways for what I would call reasonable terms. And we can kind of dive into that a little bit in the questions and answers if you guys want to. Debt to income ratio. This is a big piece of getting you qualified for a loan. That's going to be the percentage of your income that goes towards your debts. How much of your income goes towards either your housing payment or expenses like taxes, insurance, or HOAs, and on your credit report. Okay, debt to income ratio. Loan to value, that's going to be the portion, that's the equity piece that we were just talking about. How much is your loan versus how much is the value of the home? So our classic example we've been hitting, $200,000 home, $6,000 down, $194,000 on your loan. That's a 97% loan to value. Equity we just talked about. It's a dormant asset because it doesn't do anything for you unless you tap into it or use it. FHA is a loan type, Federal Housing Administration. This is a government program that opens up for people that are maybe not in the greatest or as good standing financially to become homeowners. What I mean by that is less down payment and lower credit scores. Conventional, it's a non-government program. It's a little bit harder to qualify for, but it typically has a little bit better terms. And then you may hear me allude to throughout the phrase PITI. That's principal, interest, taxes, insurance, and then it's basically your full mortgage payment, right? And then PMI or private mortgage insurance can be on there as well. Here's some quick facts, and this is from a national standpoint. I was going to do just here in St. Louis, but I opened it up and went across the board. So your average rent for an apartment is in the United States as of the end of, I think this was taken from 2020, was $11.64. All right. On average, rent goes up about 3% a year. All right. So I want to connect something right here. We were just talking about equity. We were just talking about appreciation. I said that your home appreciates, and I'm being very conservative when I say 3%. Your home appreciates 3%. Your mortgage payment outside of taxes may be going up, or if you change your homeowner's insurance policy, but your principal and interest, if it's a fixed rate loan, never change. Your home appreciates 3% year over year. You're renting, your rent goes up on average 3% a year. So that means what costs right now, $11.64, next year is going to cost $11.99. In 10 years, you stay in that same apartment. And by the way, this is for a 1-bedroom apartment. You stay in that apartment for 10 years. Now, all of a sudden, you're talking about that apartment's running $15, $13 a month. A lot of house payment for what you're paying for a 1-bedroom apartment. Average individual income in the total United States is $26,500, which is incredibly low. I think that's probably been impacted by COVID. That was lower than I expected. I did this last time I ran statistics a few years ago for some other project. I think we were closer to like 32. So I would assume that has to do with some job loss and jobless claims and that kind of stuff. But nonetheless, the numbers are what they are. 26.5 is the average individual income. The average household income, it was down a little bit as well, but 67.5 is roughly what the average household brings in the United States of America. Average credit score, 698. That's not too shabby. That's home buying credit right there. Average home sale, 477, 900. That was in the total United States in Q4 of 2021. Quarter four is what I mean, the last 3 months of the year. However, that's not exactly fair because out west, home prices and up in New York, home prices are incredibly high. I'll never forget, and this was a couple of years ago. This was before the boom over the last few years. I did a loan for this lady in New York. She lived in an 850 square foot, one bedroom, one bath. Her home was worth $420,000 in New York City. Absolutely insane. Absolutely insane. Nonetheless, brought it back home a little bit. Average home price in St. Louis City is about $244. All right. And that lines up closer to, like I said earlier, I'm in 17 states. I think in our year-end analysis, our average loan amount came out to be about $275. So, you know, the bottom line is your estimated payment all done, principal, interest, PITI, principal, interest, taxes, insurance, PMI, everything all said and done on a home of that value, depending on what your taxes are and what the homeowner's insurance policy that you select is going to be between $1,400 and $1,500 bucks. And you're getting home ownership and you're building wealth and you're building equity, and you don't have to worry about this right here. Instead of your average price going up 3% every year, you're building equity at about 3% every year. Puts the ball in your court. It's a big deal. How to get ready to buy a home. It's one of my favorite subjects, and again, not sound like a broken record, but really and truly, I do think, and I will continue to advocate for. This is something that, whether it's junior year, senior year, whatever the case is, at some point in high school, this should be a class that we have to take. Nothing against Algebra 2 with trig, but I can't tell you the last time I had to solve for X. What we got here is the process I alluded to earlier. You want to get pre-approved first. And the reason for that, a lot of people think, oh, I need to go get a realtor. I want to look at houses. There is nothing wrong with finding a realtor first. There's nothing wrong with speaking to a realtor, having somebody, building that connection, making sure you have somebody that you can trust and start building that relationship with. However, especially in this market right now, no realtor that, let me phrase it a little bit more delicately. Very few realtors that are successful and that you would want to use because they're good at what they do and they value their time are going to show you a home without a pre-approval letter. And the reason for that, and in fact, a lot of times sellers, if your realtor, even if they're willing to go show you the home, the listing agent will say, are they pre-approved? Can we see a letter before they come look at the house? Because nobody wants to show a house that you can't buy, right? And that's just the honest truth. So that's why getting pre-approved on the front end is so important. My man Mikey, I see him. Get pre-approved on the front end. Find your realtor. And a key here, if you do your own house hunting, I can't tell you how you see it's all capitalized. Never use the selling agent as your agent. Okay. A common mistake that I see a lot of first-time home buyers make or start to make, I correct it when I can, is they think that they are paying their realtor. You as the buyer do not pay your realtor. Your realtor is paid through the sale of the home by the sellers. And guess what? It's 6% split for the most part. They might negotiate, the sellers might negotiate it down, say it's 4% split, whatever the case is. It's a split between the listing agent and the selling agent, or excuse me, the listing agent and the buyer's agent. Now, what that split looks like, it varies. It's agreed prior to, it's on the MLS. They will have it understood what that split looks like, but ultimately the seller pays your realtor. And when you use the listing agent as your realtor, guess who hired that listing agent first? Guess who that listing agent works for? The seller. They're not, and I'm not gonna sit here and beat them up and say, oh, they're not looking out for you. They don't care. They're gonna look. There's a lot of great agents that will get you a fair deal and represent both sides and do a great job of it. But for the most part, and it's just common sense and it's a reasonable thing, right? They were hired by the sellers to sell their house. That's where their loyalty is going to lie. So if they can get a better offer and then keep all the commission, they're going to do that all day long. So get your own realtor. And that is something that we help with. We have a lot of great realtors that we work with. And even if it's in an area that I've never closed a loan before, or my loan officers have never closed a loan before, we know what to look for. We know how to interview agents. We know how to reach out to them and make sure that they are a true client-oriented agent and they're not just out to get a buck. So if that's something you need help with, I'm more than happy. My team is more than happy to help pair you with a winning agent. That's for sure. So then once we get pre-approved, we find an agent, they send you home, you find a home, you get into contract, we get the inspection, we order the appraisal, we get our conditional approval. Conditional approval is where the underwriter says, yep, we're gonna finance this loan under these conditions. And then they'll tell us what we got to do to get the loan. It's usually pretty simple stuff. Verify employment, show us your bank statements. Basically, it's just verifying. In mortgages, we have a saying, trust God, verify everything else 3 times. So it's just verify, verify, verify is pretty much what it comes down to. For us, because we process our own loans, about, I would say, easily 60 to 70% of the conditions, the borrower, the realtors, never any wiser to it, because we do it all back in and we don't have to get, we try to keep it as painless as possible for our buyers and our loan partners. Then once we get all those in, we submit it back up to the underwriter, we get our final approval, and then we get that, my 3 favorite letters, baby, CTC, clear to close. And we're closing on your home with big smiles. Generally speaking, when I'm prepping somebody for home ownership, there's what you can do, there's what you should do. So we'll go over both. What we can do, we have programs that go all the way down to 500 credit scores. We have programs that go all the way up to 56.99% debt to income. That means for every dollar that's coming into your household, 57 or 56.99 pennies is going towards something that reports to your credit or to a home expense. Guess what doesn't report to credit? Groceries, gas, utilities, laundry list of stuff, right? 57%, especially for a first-time home buyer, is detrimental. That is setting you up for failure. So even if you have an 800 credit score, and when I run my findings, you're at 57% or 56.99% and it's approved eligible, we're sitting down and we're having a conversation what that looks like. And I've got to hear something to make me feel comfortable on, oh yeah, well, no, my wife's not on the loan. She works as well. So really we got to, or I've got a side hustle, man. I sell bottle caps inside. I don't give a shit. Whatever it is that you do, you have something that you're doing on the side that generates income, and we're just not qualifying that income. Okay, that's a little different. Generally speaking, what I advise my clients, we want to get up to at least a 640. All right. And we want your debt to income ratios. I really want it under 40%, but 35% is that's where I try to shoot for. 35%, 40s really, that's kind of that's where we're starting to have conversations at 40%, because, you know, calling it what it is. If we go back and we look at, and this ties into why I say there's not a bust looming, there's not a home market boom or bust where things are going to go to the tank like they did in 08, 09, because back in 08, 09, lenders, mortgage brokers, mortgage bankers didn't have to verify the ability to repay. We have to now, and thank God for that. So that's one key factor. There's inventory. I could get off on a whole tangent on why we don't have to worry about that, but that's a class for another day. And I'm going to bring it back home and just say very simply, the way that we operate here at Gateway is, this is how myself, every single one of my loan officers and loan officer assistant that you saw a little bit earlier, this is how we take care of our families. There's no 2 ways about it. This is a business, and we're here to be successful. But I only hire good people. I hire good people that care about people. We have a saying in my office, only quality people. And we truly do care about our clients and setting you up for success. So I have never written a loan, and none of my loan officers have ever written a loan that's been defaulted on, or that we've had to worry about being defaulted on, because we take the time to go through and really understand what the situation looks like and set our clients up for success. All that to digress and say, so my advice on when I'm prepping a borrower for home buy, at least a 640, you want to save up at least 3% of your down payment, and then an additional $3,000 to $5,000 for closing costs. Keep items away from collections. So don't pay your bills. Don't let things go into collections. Get pre-approved about 30 to 45 days before you're ready to seriously shop. Like I said, there's lenders that'll go 500 credit score, and then there's but there's going to be higher down payments and higher interest rates and the whole slew. I've got lenders that can do it. I've never written a loan under 580. Because for me, it's worth educating my client, showing you how to get your credit up, showing you how to get into a better position, and saving the money over the long run. The other thing that I'll add on here and need to add on here is, and we're going to talk about it a little bit, but is you want to have at least 3, really ideally 6 months of reserves, cash put back, call it a oh crap fund, that you can, because when you're a homeowner, you don't have the landlord to call and say, hey man, the AC's out, right? Those are things that we got to fix. Those things we got to take care of. So, and that being said, lender will want to see 2 years of job history, same field typically. We get pretty creative as long as you're been a W-2 employee for 2 years, and I can some way, some shape, some fashion shape that it's in the same industry. I can typically get as long as we got a 2-year contingent continuance of work history, I can make that work. Just make sure you don't quit your job during the process. And then understand assets over liabilities. Things that make you money or grow your portfolio, things that depreciate in value or cost you money, liability. Who will you be working with? Well, if you take my advice, you'll be working with a mortgage broker, whether it's me, one of my fine LOs, or another brokerage. A lot of great ones out here, or a mortgage banker if you're silly and ignore this advice. But brokers are truly better. But this is ultimately a licensed party. Brokers are always licensed. Mortgage bankers don't necessarily have to be licensed if they're under FDIC charter. In fact, I'll be completely honest with you. My first 1.5 years in the industry, I didn't have to be licensed. I was writing mortgages. I didn't have a license. When I got into mortgages, I didn't know my elbow from my nose when it came to a mortgage and what anything meant. It was trial by fire, and it was fail forward. If you're working with a mortgage broker, they 100% have to be licensed in order to get the loan done. And then they're the party, the mortgage banker, broker is who's the licensed party that's going to make sure that they go over loan terms with you and match you with the right product for your needs. Your processor is the person that helps you gather docs and meet underwriting conditions. Here at my branch, that's one in the same, and there is no extra fee for it. We cannot charge for that processing fee. It is a straight. That's how we separate ourselves in the market, is we process our own loans. Underwriter, that's who's going to make sure that the loan actually does meet the qualification requirements. Title is who's going to get our legal recording and paperwork together to get the home in your name. And then your realtor is the rock star that's out there on the front lines, that's helping you find the home, that's explaining your options and helping negotiate the deal for you. All right. Realtor is very, very important. And I get it. One question I get a lot is, do I have to have a realtor? What if I'm doing a for sale by owner? Do I have to have a realtor? The honest answer is no, you don't have to, but you can go to court and not have a lawyer. You want to represent yourself? Yeah, you're probably going to jail. All right. I'm just kidding. All right. So kind of. All right. So first types of home buyer loans. So our first one we got here is our conventional. That's the one we shoot for, right? It's going to be your 3% down. Cannot be on the title of a home in the last 3 years. So key here, you can qualify for a conventional first-time home buyer home, our first-time loan, and owned a home 10 years ago. As long as you have not been on title on a home in the last 3 years, you're a first-time home buyer in the eyes of a conventional loan. Typically, what I try to get my clients to is a 680 or better credit score to get this loan done. And then your PMI will drop off PMI means private mortgage insurance, will drop off at 78%. And I should have had private mortgage insurance on important terms, give you the skinny. Private mortgage insurance is exactly that. It's insurance, does nothing for you, the borrower, does everything for the lender. It ensures the lender that if you were to default on your mortgage, that they've got collateral, they're covered. They're not going to lose on your loan. This is another reason why we don't have to worry about a housing bust. Lenders' loans are insured, they're protected. If you foreclose on your home, the lender's they're not out that money. They've got insurance on it. For the most part, there is exception there, but for the most part, if your home has PMI, if you borrow more than 80%, that loan has PMI. Down payment assistance programs, also known as the bane of my existence right now. So down payment assistance programs, sometimes they're grants, sometimes they're loans that help people with need a down payment. They can be very hard to qualify for, and I do not recommend them to be relied on. And full picture on why. Right now, the honest answer is they're just not competitive. They're not a good loan. A year ago, they could make sense if you had good credit and had a little bit of money to bring to the table, because it is an assistance, not a replacement, but an assistance program. But right now, and even last year, when I explained it to a borrower, only about 30 times when the borrower got every piece to the puzzle and everything explained to them, would they elect to go through a down payment assistance program. Most of the time they'd say, you know what, I'm gonna wait another 2 or 3 months to get my money right, and then I'm gonna come back and get this loan through a conventional or an FHA loan. And the reason is, on average, your down payment assistance program loan, right now, I told you earlier, on average, the average interest rate is probably flirting somewhere in the ballpark of about 5.5%. On a down payment assistance program, last time I priced one out, 6.75. Whole point and a quarter higher. That's a lot of money when you're talking about a $200,000 loan on a monthly basis over the term of a 360 term. Now, that being said, there's different types. I'm not going to spend a whole lot of time on DPAs in this particular class, even though it is a home buying class, just because with where the market is in 6 months, maybe I spend 20 minutes talking about DPAs because they're competitive again. But at this juncture, they're just not, it's not a good program, and it's not something that, and once you get all the pieces and you're educated on it, I would drop that 30% it was last year down to probably like 10%. Most people are not going to take a DPA right now. If you have been on title in the last 3 years, you would not qualify for a first-time homebuyer loan, but FHA is always at 3.5% for a primary residence, and then your conventional loan would just switch to a 5%. So not a big change there. How to establish credit. All right, so this is a pretty important one. Biggest thing is, the biggest thing about establishing credit is responsibility. So you never want to borrow more than you're able to pay back. The ways that you can safely and responsibly establish that credit is you go to your bank, you open up what's called a secured credit card. Secured credit card anybody can get. Even if you have a 400 credit score, you can get a secured credit card. The way that a secured credit card works is you walk into that bank, you take $500. Here you go, Mr. Banker. I want a secured credit card. Please give me $500 back on my credit card. They give you that $500 you just gave them by way of a credit card. They're not out any money, right? All they did was they take your money and they gave it back to you on a credit card. Now you go to the gas station, you fill up the tank. These days, it's going to cost you $100. You buy groceries. That's another, these days, $200. Now you've got, of that $500, you just ran up your credit card, $300. The way I recommend my clients to use their card, I personally bank with Regions. This is not a plug for Regions. I don't care what bank you do it at. I say Regions because I know Regions. I have the ability, I can go in on my credit, I can go in, charge my card. By the time I've gotten back out to my truck, I've gone on to my app, boom, transferred the money back over to my credit card. It's called a transactional user. That's going to boost your score up the quickest. Because what you don't want to do, okay, if you run that card up $300, you need to get it back to that $500 limit. Because what you don't want to do is you don't want to have the credit card report over 30%, ideally 10% utilization when the card reports. So important questions to ask when you establish whether it's a secured credit card or if you qualify for a regular credit card is, when do you report? And when do I have to have my payment down to what I want it to be to show? It's really the same question, two different ways, but make sure you have ultra clarity, because you might open it on the 20th of April and then they report on the 3rd of May, the 3rd of June, the 3rd of July, but you're thinking, wait, I opened it on the 20th. Wouldn't my report date be on the 20th? Not necessarily. So make sure you know when they are actually reporting, because that's going to dictate what your credit score reflects. Okay. So if you get a secured credit card, that scenario I just ran through, you're using it as a credit card and it's like, I don't get paid till Friday, but I need gas in the car and I got to feed these hungry kids. I got to get to the grocery store, and you run it up $300. You don't get paid till Friday. Just make sure by Friday, once you get paid, you take that $300, you're paying that down to at least a $50 balance to keep that report in your favor. Because if you do it the other way, if you run it up to $500 on that secured credit card and it shows you have a zero limit, now you're hurting your score, not helping it. All right. Rent to own furniture. I say this with caution. There's a couple things to know here. So you go to Aaron's or rent to own or whatever your Value City Furniture, whatever the case is, you ask them if they have a interest-free period. Most of them do. It's typically about 6 months. Now the key here is it's interest-free, right? But you're probably paying $800 for a $600 couch. There's no such thing as a free lunch. They're going to make their money somehow. But that being said, this is one of the few ways that you can get it reported on your credit, because you have to. That's the fickle thing. That's the funny thing about credit is you have to. If you don't, no credit is just as bad as having bad credit. If you have no credit score, it's just like having a 580. So this is one of the few ways that you can have no credit score or bad credit and still be able to establish it or get your score up in a favorable way. This one right here, authorized user, key word, and I'm going to say it before I even tell you what it is. Responsible, responsible, responsible. Authorized user, be put on somebody responsible credit card, right? So that's mom, dad, sister, brother, best friend, cousin, I don't care who, as long as they are abiding by what I just said earlier, 30% utilization rule, ideally 10% utilization rule. If they put you on as an authorized user, you get to reap the benefits of them paying their card on time. Now, key here, this is something to know, it's also a liability to you. So when I run your credit report and I get your DTI, that card, even though it's not your card, you're just an authorized user, it's going to report against you. So that minimum payment will show up as a liability for you. Not that big of a deal. We can get you taken off as an authorized user and remove it. You still get the benefit, all that good stuff. And this one right here, Experian Boost, you see I got a little asterisk. I have never done it. I have clients tell me it works. I've heard really good things about it. But because I don't have any personal experience with it, I'm not going to endorse it more than to say I hear that it works and it's something to look into. I have also, I'll say that in the next breath to tell you, I've heard it have the opposite effect too. But what it is you tell Experian, hey, or your landlord or whoever, I want my rent recorded and other different factors, utilities, whatever the case is, that can raise your score. Netflix, power bills, those are some things I've seen on people's credit reports. But the key is you've been responsible with those accounts. So if you ain't paying the rent on time and Mr. Landlord comes in and says, yeah, we'll report to your score, your credit report, and then it's a bunch of 30-day lates, you just shot yourself in the foot. So just keep that in mind. Don't go having bad accounts reporting onto your credit. And then in bold, all capital, highlighted if I could, never let anything go into collections. All right. So a couple years ago, I used to work for T-Mobile. Hated that job. Was not good at that job. Could not sell old people smartphones. I just, something about it, I just couldn't do it. But that being said, I love a good deal, right? So I walk into my T-Mobile, actually the same one I used to work for. Didn't know anybody in there. And as I'm paying my bill, dude's like, "Hey man, you want a free tablet?" Like, man, I know this game. I used to work here. No. He's like, "No, bro, for real, it's a free tablet, man. It ain't nothing to it. No gimmick. Free tablet." My goofy self, free tablet. Yeah. So I sign up, I get this free tablet. Well, the tablet was free, but the $20 add-a-line was not free. So I get my bill 2 months later and it's $20 higher than it's supposed to be. I call T-Mobile. We have a real friendly conversation, as you can imagine. I cancel everything. They say, "Mr. Estes, you can cancel that, but you're out of your 14-day return policy on your tablet. So that's going to be $250. What? Right? So I had to make a decision. And ultimately, because I understand the way credit works, I understood that $250, even though I was right in principle and ethically, they should not have done that to me. I also shouldn't have, I knew there was a catch, and I didn't go through it to figure out where the catch was until it got me. But at the end of the day, that $250, even though I was a broke college kid at the time, was worth it to pay to keep that account from going to collections than what it would have been to take my moral stand and, "No, you're not going to get me. I should have this. Someone drop this tablet back off at the store," and then get hit with them sending that account to collections and then it being on my record for either 7 years or until I pay it. Oh, and the key thing about collections is if in that scenario, I did decide I'm going to let it go to collections, it goes to collections. 3 years later, I'm ready to buy a house. Man, your credit score is just not quite high enough. You got this collections account. I call the collections, I pay it. Now it's a brand new collections account reported. So it drops my score instead of improves it. Never let anything go to collections. It's not worth it. It's not worth it. So just keep that in mind, because I see it all the time where I'll see something in collections and it'll be a very similar story to that. Poor borrower didn't do anything wrong, right? They got by a good salesman or a bad salesman, however you want to look at it. And they took their moral stand, and I shouldn't have had that in the first place. They tricked me. Well, now they tricked you. They got their money, because they get their money regardless. And you're sitting there with a dinged up credit score because you let that go to collections. So I can't stress that enough. Do not let things go to collections, even when you're right. All right. So let's see. From here, how to save. Again, this is one of my favorite topics to hit, because it's very, very, very important to understand. So and not hard to do if you do it right. So I suggest the 10% rule. You ever looked at one of your pay stubs on your gross versus your net? You can't look at it too long because you'll need a trash can, because it's going to make you sick. But if you look, what you pay Uncle Sam every time you get paid, depending on your tax bracket, it's going to fall somewhere between 15 to 30%, right? Not to mention healthcare, insurance, the various things that get held out of your check. Well, what you need to do, what I highly suggest doing, is taking 10% of whatever your gross check, and maybe it's your net, maybe things are tight, you can't do 10% of your gross. Okay, 10% of the net, what you take home, whether it's $60 or $600 out of that check, you put it aside and you invest in yourself. And when I say invest in yourself, I mean, think of it as a U tax. This is you paying yourself. This is you helping you build your own wealth. I do not necessarily recommend, you need to have your oh crap fund put aside for sure. That's cash on hand. But when inflation's at 8.5%, you put $100 in the shoebox. This time next year, you just lost $8.50 and you ain't even bought nothing, right? So it's better if you understand investing, if you're able to actually put it into some kind of investment vehicle, and turn it into generate you money. One that I lightly endorse, because it is ultimately, with any investment, it is a risk. They could change the rules on it tomorrow and it may not always be where it's at. But right now there's an app called Anchor USD. Last time I did this, it was at 7.5. Let me see where it's at right now. Anchor has a savings account at I believe it's 7.5% APR. Your bank very likely is at about 0.1% APR. That means that this investment is, and I'm logged out of my account. I don't remember my password. That's beautiful. So I can't tell you exactly what it is this second, but Anchor USD is the name of the app. 7.5% APR on the savings account, which is an insane about 160 times what the industry norm is. Okay. It also has a way where you can buy crypto, you can buy stocks. It's a fantastic app. I really do enjoy it. But at the end of the day, I'm gonna follow it up with the disclaimer. It's your money. Where you put it is where you put it. Don't put it there and then say, Dylan told me to do this. No, that's just simply one of the places I put my money because it's smart money. 7.5% on a pure savings account is an insane return, and definitely one that is worth looking at. It is a good place to put your U tax. And then the biggest thing I can tell you, man, is invest in yourself. Do things that make you happy and become more profitable. I cringe when I hear people say, oh, I can't enroll in that class. I can't do that. I can't take that course. That's too expensive. And it's a $500 course. And then their phone rings and they pick up their $1,500, $1,000, whatever the case is, iPhone. Priorities. Invest in yourself. Take a class. Do something that gives you a skill to make money. And then, and it doesn't matter if it's woodwork, whatever it is, you take that class, you get the skill, you turn it, you do it 1 or 2 times, figure out you don't like it. But if you have that skill and you can make it profitable, worst case scenario, you make your money back that you took to invest in getting the skill, and then you don't do it anymore. But this is a liability. It's $1,000 I'll never get back, right? That's just there now. So break that trend, and that's one of the biggest things I preach to my kids, to my nephew, to the youth in my life, to the people in my life that I care about. Don't let me hear you say that's too expensive. I can't do that. To invest in yourself. Invest in yourself. And then from there, this is one thing I probably need to admit. It says set realistic goals, write them down, and remind yourself and stick to them. As far as realistic goals go, that's something in my own personal life I've kind of changed after some coaching, investing in myself, speaking with people that are smarter, better, faster than me. They all have ridiculous goals, and they set those goals to be unattainable. They know they're unattainable, but they're shooting so far higher than what is obtainable, and their end result is a whole lot farther than what they're realistic expectation should have been. So I don't care how you set your goals how you're going to set them, and then remind yourself of them and stick to them. All right, so we saved, we got our process down, we got pre-approved. Now what? Go credit dormant. What do I mean by that? I mean, don't do anything to your credit. Don't go getting no new credit cards. Don't go set up a secured credit card. Don't get any new loans. Don't do anything with your credit. Do not let your credit be ran until your loan closes. With the exception of homeowners insurance, they might have to run your credit, but with very little exception. Let me say this. Don't let your credit be ran without talking to your mortgage broker. Let's simplify to that. Don't change jobs. Literally just had this happen today. Do not change jobs during the process, please. Don't blow your money. So I just talked to you about how to save up, put that 10% aside, all that good stuff. You do that, you start making a pretty good chunk of change. Now you're going to buy this house, and oh man, I'm going to move in this house and I'm not going to have any furniture. Yeah, you know what's better than moving into a house with you know what's better than having furniture? Having a house, right? Go get the house, get you a blow-up mattress for the first few weeks. Then go get your furniture. Go get loans for furniture. Go do what you got to do to get the furniture after we secure the house. Call that U-Haul money. Save that until the loan closes. And then the biggest thing I'll tell you is make a list of what's important to you and review it with your realtor. A lot of times, one of the things that I see first home buyers especially do is they'll have in their mind what they want, but they don't really formulate it. They don't talk about it. Realtor asks, hey, what are we looking for? Oh, I need 3 bedrooms or 2 bedrooms, whatever the case is. I need a master bath in my bedroom. But they don't write down the things that are important to them. And then they go buy the house, and they get a contract for the house. And then they realize after the contract, oh, this doesn't have a fenced backyard, or doesn't have XYZ. And then they start getting buyer's remorse. Make that list, talk it over with your realtor so that you guys are on the same page. They're showing you houses that meet those expectations. And then ultimately, you don't feel the need, because this is another thing I'll say on this page. Once you get in contract, stop looking at houses. Don't do it. It's a fool's game. You're going to lose. But you're going to get a beautiful house that you get under contract for. And then the next day, something better is on the market. Inevitably, it happens. It doesn't matter what's on the market. You're in contract. You like this house enough to get into contract for it. Stay the course. Don't look at houses once you get into contract. You will be disappointed 10 out of 10 times. And really and truly, if you do this last thing right there, second to last thing, you make that list and you review it to your realtor with your realtor, you're going to get in contract on a home that you love anyway. And then get excited, man. We're about to be homeowners. And that is awesome stuff. And it puts you in, regardless of whether you're the first homeowner in your family or everybody in your home, everybody in your family owns a house, you're building wealth. You're doing something for you. You're building your portfolio. It's something to feel good about. It's something to get excited about. It's much, much better than paying rent. Responsible home ownership. I alluded to this earlier. Try and always have 3, preferably 6 months reserve, or what I call oh shit money. Life happens. Be ready for it. Be ready for it. And I'm telling you, it is a much better feeling when you've done that 10% rule and you get that squeaky wheel, whatever that squeaky wheel in the house may be, and you're just able to dip into that fund, take care of it, move right along, because you don't have the landlord anymore to call and say, hey, can you send somebody out here to fix this? It's on you. And then the biggest thing there is make sure that when something breaks, that you fix it as soon as possible. Because the thing about your home is you get a crack in the foundation, it's only going to get bigger. You get a leaky pipe, it's only going to get worse. And then that water damage goes down into the walls. Then you got to replace drywall. Then it gets to the floor. You got to replace flooring. It just gets worse and worse and worse and worse and worse. So you want to be able to take care of those things as soon as possible. And then just make sure, depending on what part of the country that you're in, that you're keeping up with your seasonal needs, whether it's winterizing, summerizing, whatever the case is, that you're setting your house up to be secure over the whatever the season may be. Other types of loans that I was trying to keep this to about an hour. We are well over that. So if you have questions about these, you can reach out. I'm happy. I could spend another hour talking about damn near each one of these, but I'll save you the time. We got our DSCR. That's an investment loan, debt service coverage ratio. Very simply, it's a loan that is not based on your income. It is an investment product that is based on the rent schedule and what the mortgage is. As long as the rent that you are going to collect from the home that is proven by an appraisal and a rent schedule covers the cost of the mortgage, we can get the loan done. All you got to do is have a down payment of 15% or more. Bank statement program is going to be for your self-employed or business owners that can qualify for a loan without having to worry about having tax write-offs. Commercial, that one's pretty self-explanatory. It's for commercial buildings or projects. Hard money loans and fix and flip, they kind of go hand in hand. They're a little bit different. Hard money loan is for a short term. Take out a hard money loan of $60,000, you invest it. At the end of that, whatever the term is, say it's 6 months, that $60K in full is due. Bam, right then. Fix and flip, that's going to be your investor loan. You buy a house, say for $40,000, you do $20,000 worth of work, you get a fix and flip loan for that $60,000, and then you sell it for say $100,000, you pay back the $60K that you owe on it. Your land loans, they typically require 40% down, and there can't be any legal dwellings on the property. And simply put, really, if it has anything to do with a mortgage, we can do it at Gateway. These are all the different programs that we have. Lots of different programs. Doesn't matter if whatever you're trying to do, if it has to do with a mortgage, reach out to us. We can help. And I will tell you, one of my favorite things, one thing I say with a lot of pride, and the right kind of pride, with the business that we are building and have built and bringing on only quality people, is we can do all these. We're not necessarily the best at home equity line of credit. If you came to me and you needed a home equity line of credit for $10,000, I've got referral partners, and that there's no kickbacks, nothing like that. It's just, hey, I know this person can get this loan done for you better. I'm going to put you over with whoever that may be. So if you ever need a good, honest synopsis of what the situation you're looking at is, if we can help you and we're competitive and it's our product, boom, we're going to take care of you. If it's putting the ball in somebody else's court that can do it better, we're going to do that with a smile on our face, because we don't rely on any one loan. We rely on putting people in good loans with the right people and doing right by people. That's our ethos here. You've got questions. That says I've got answers. That should be we've got answers. I've got 2 great loan officers, an amazing loan officer assistant in the chat. You have the basics to home ownership. This right here is my personal cell phone. Stacy, Heather, if you guys want to put yours in the chat so they've got that as well. At any point in time, if you need anything at all, don't hesitate to reach out. At this point in time, like I said at the beginning, because I have done I've been very diligent in hiring the right people and bringing on people that care about people, only quality people. I am able to back off a little bit of producing. So there's a very good chance that if you reach out, I'll answer any question. I'll take care of you on the front end, but I'll probably link you with either Heather or Stacy to get you through the product and just be our process, and then just be a resource throughout the way. And then, yeah, take a few minutes. If you aren't already, follow us on Facebook. That's my website. Stace and Heather both have websites as well. But If you guys need anything at all, thank you very, very much. We appreciate everybody that showed up for the course. Hopefully you found it informative. And if anybody has any questions, we can open it up to questions and answers now.
All right, that was awesome, man. It was very informative. I really appreciate that. Honestly, can you hear me okay, Dylan?
Absolutely.
All right. I mean, honestly, I wrote down a bunch of questions. You pretty much answered all of them, but then I just came with a few more because that's the kind of guy I am.
Man. I love it, man. Hit me with them.
I like to ask everything. So when I was looking at that one slide you had, where it talked about like different kind of loans, you had that one option. It was like one more back. It had the one option where you talked about the 40% down on the land. Now, in your experience, is it better to get like land and build a home, or is it usually just kind of cheaper buying a home? Or I don't know. I'm sure there's pros and cons to each of those options.
Yeah, that's a great question, man. And so honestly, for like, so you see this one-time closed construction. That's typically what we shoot for. Because you're getting the best of both worlds. You're able to get the property, get the construction, and then the loan itself. When we close on it, it's all done in that one mortgage, rather than having to get the land mortgage, put 40% down on the land, then go get a construction loan, and then convert the construction loan over to the long-term mortgage. So there's more than one way to skin a cat. But ultimately, the best way to do it is the path of least resistance, and for the most part, that's going to be that one-time clear to close.
Okay. I know I like to watch a lot of HGTV, so I know about the wish list people have when they go get houses. And I just always wondered if it'd be easier if we just made built our own house and had everything on our wish list on it, but in my mind, it was always like that seemed like it would be way more expensive to go that route. So I was always kind of interested in that. I don't want to take up too much time. So when you said that first step in the process is getting that pre-approval, do I just go to any LO, or do I go to an LO, or do I go to you? Or I'm sure you. I'm sure I would go to you.
You got me, big guy.
But just for my own knowledge.
I know I made it sound like you got a choice, but I'm looking at the participants, man. Ain't nobody in here but us. You come to me, big guy.
No, I know you do a great job, man. I talk to a lot of other people that that go through you, like Adrian, of course.
Yeah, man.
And I know if Adrian uses you, then you got to be good.
Dude, man, that made my heart sing when Adrian called me. I'm not gonna lie. I'm like, yeah, I'm doing something right, baby.
I was like, he's got some high standards.
How many have you closed with Adrian so far? Close about what, 5 with Adrian so far?
I wish it was that many. We've done a few though, 2 or 3.
He did tell me there was like multiple things that he had in the works with you, so that's cool, man. Here. Last question, I know you get this a lot, especially in today's world, like you were talking about with the debt. So the student loans, is that just kind of factored in like any other kind of debt, or is that completely different with guys coming to college?
It's a little bit different, man. So for student loans, there's different formulas. There's different ways that they take them into consideration, right? And it's about to change because now everybody's coming out of forbearance, right? While they were in forbearance, it depended on the loan type that you were doing. We either used 0.5% or we used 1% FHA versus conventional. Now, once you start making payments on them, then there's going to be formulas to either we take the payment that you have, or if you're on a forgiveness program, we can take that into consideration. And then there's even some programs that we have that we can kind of manipulate it a little bit. And if we can get the payment based on an equation down lower than what your actual payment is, we can do that as well.
Sorry, I had to mute my phone over there.
That's good, man. That's good.
He's trying to learn too, man. Okay, yeah, awesome. I appreciate all the information, man. Like I said, man, everything is really informative. I'm kind of like Adrian in a way where I like to have all my bases covered, all my T's crossed, I's dotted. So you knocked out everything from start to finish. I feel like, before going into this, I didn't know what to do. Honestly, I would just call you. Now I feel like I actually have a little bit of knowledge where I can at least point someone in the right direction. So I really appreciate it. It was great presentation.
Thanks, brother. I appreciate the feedback, bro. For real, I do. Thank you.
Yeah, for sure, for sure. Okay, I'm gonna mute myself again.
Damon, thanks for coming, Michael. Calling you by your government, man. Who does he think he is? All right,
Wait, two people call me Michael. It's my mom and Kristen.
I know, man. He thinks he's slick. But awesome stuff. So with that, I'm gonna go ahead and stop this, and I'm going to stop the